Russia and Saudi Arabia have called off their brutal price war and are now pushing dozens of major crude producers toward a deal that would slash production and help stabilize a market that's been rocked by the coronavirus pandemic. A marathon video conference between OPEC members and other major energy powers on Thursday ended with a tentative deal to reduce production by 10 million barrels per day in May and June, the deepest cut ever agreed by the world's oil producers. But there was a major snag. Mexico has declined to support the agreement, and meeting participants said acknowledged in a statement that final agreement is conditional on the country's consent. Another round of talks between the Group of 20 is scheduled for Friday. Earlier Thursday, a senior OPEC source told CNN Business that Mexico expressed reservations about the scale of their cut and the length of the agreement. While the most severe cuts are only scheduled to last until the end of June, production cuts in some form would last until 2022. Even if the deal is finalized, the decline in production would amount to only about 10% of the world's normal supply of oil, far below the estimates for how much demand for oil has collapsed in the wake of the coronavirus crisis. And it is unlikely to stem the massive plunge in oil prices in recent months. Attention now turns to the meeting of G20 energy ministers, who are scheduled to meet at 8 a.m. ET. To foster global dialogue and cooperation to ensure stable energy markets and enable a stronger global economy. The group, which includes Mexico, could consider production cuts. Oil producers are desperately seeking to boost prices after Saudi Arabia and Russia abandoned years of production cuts in early March, launching a price war by flooding the market with crude. A massive drop in demand for energy caused of the coronavirus pandemic pushed prices even lower. Thursday's meeting began with OPEC Secretary General Mohammed Sanusi Barkindo sounding the alarm about both oil prices and demand. For the oil market, the coronavirus has completely upended market supply and demand fundamentals since we last met on March 6, he said, according to a transcript of the remarks. Our industry is hemorrhaging. No one has been able to stem the bleeding. Barkindo said that projections call for demand of nearly 12 million fewer barrels per day in the current quarter. These are staggering numbers. Unprecedented in modern times, he said. At that rate, given the current unprecedented supply and demand imbalance, there could be a colossal excess volume of 14.7 million barrels a day in the second quarter of 2020, he said. Even those dire forecasts may be too optimistic, as they can underestimate how much demand has fallen with harsh restrictions on travel, work and public life now in place in much of the world because of the pandemic. Tom Closa, the chief oil analyst for the Oil Price Information Service, said he believes demand is down as much as 18 million to 20 million barrels a day. This cut is woefully inadequate to stabilize prices into at least the summer, he said Thursday. The deal would see the output reduced to 8 million barrels a day from July to December, followed by a 6 million barrels a day reduction from January 2021 to April 2022. Iran, Libya and Venezuela would be exempted from the output cuts due to sanctions or lost production.